Before you start dealing with taxes, it's crucial to understand the basics of tax brackets. Tax brackets determine how much tax you pay on different portions of your income. Instead of taxing all your income at one rate, the government divides your income into segments, each taxed at a different rate. This system is called a progressive tax system, and it's designed so that higher earners pay a higher percentage of their income in taxes. Knowing how these brackets work can help you plan your finances and avoid surprises when tax season arrives. Let's break down what you need to know before you get started. Tax bracket is simply a range of income that is taxed at a specific rate. For example, if you earn within a certain range, you'll pay one rate on that portion of your income, and a different rate on the next range. This means your total income isn't taxed at just one rate. Instead, as your income increases, only the amount that falls into a higher bracket is taxed at the higher rate. Understanding this helps you see why your effective tax rate is usually lower than your highest tax bracket. Progressive tax system is designed so that people with higher incomes pay a higher percentage in taxes. This doesn't mean all your income is taxed at the highest rate you qualify for. Instead, only the portion of your income that falls within each bracket is taxed at that bracket's rate. For example, if the first bracket is taxed at 10%, only the income within that bracket is taxed at 10%. The next portion is taxed at a higher rate, and so on. This structure aims to make taxation fairer. Understanding tax brackets is important because it affects how much tax you owe and how you plan your finances. If you know which bracket you fall into, you can estimate your tax bill and make smarter decisions about saving, investing, or even timing certain income. For example, if a bonus pushes you into a higher bracket, only the amount above the bracket threshold is taxed at the higher rate. This knowledge can help you avoid common misconceptions and plan more effectively. It's easy to confuse your marginal tax rate with your effective tax rate. Your marginal rate is the highest rate you pay on your last dollar of income, while your effective rate is the average rate you pay on all your income. Because of the bracket system, your effective rate is always lower than your marginal rate. Understanding this difference helps you better grasp how much you're actually paying in taxes and can help you make more informed financial decisions. Tax brackets are structured in tiers, with each tier covering a specific range of income. For example, the first bracket might cover income from $0 to $10,000, the next from $10,001 to $40,000, and so on. Each tier has its own tax rate, and only the income within that tier is taxed at that rate. This tiered structure is what makes the system progressive and ensures that everyone pays a fair share based on their ability to pay. It's important to know that tax bracket thresholds can change from year to year. Governments may adjust the income ranges or tax rates to account for inflation or policy changes. That's why it's essential to check the current year's tax brackets before you start your tax planning. Staying updated helps you avoid surprises and ensures you're using the correct information for your calculations. Your tax bracket isn't determined by income alone. Your filing status, such as single, married, filing jointly, or head of household, also affects which brackets apply to you. Each status has its own set of income ranges for each bracket. This means two people with the same income but different filing statuses could be taxed differently. Understanding your filing status is a key step before you begin calculating your taxes. When you hear about tax brackets, remember they apply to your taxable income, not your total income. Taxable income is what's left after you subtract deductions and exemptions from your gross income. This is the amount the government uses to determine which tax brackets you fall into. Knowing how to calculate your taxable income is essential for understanding where you stand and how much tax you'll owe. Deductions and tax credits can significantly affect your taxable income and the bracket you end up in. Deductions reduce your taxable income, possibly lowering you into a lower bracket. Tax credits, on the other hand, directly reduce the amount of tax you owe. Understanding the difference and how each works can help you make the most of your tax situation and potentially save money. You'll need to decide whether to take the standard deduction or itemize your deductions. The standard deduction is a fixed amount that reduces your taxable income, while itemizing lets you list specific expenses like mortgage interest or medical costs. Choosing the right option can affect your taxable income and in turn your tax bracket. It's important to compare both options to see which benefits you most. If you receive extra income like a bonus or freelance work, it could push part of your income into a higher tax bracket. However, only the amount above the bracket threshold is taxed at the higher rate. This is a common area of confusion, but understanding it can help you plan for the tax impact of extra earnings and avoid unnecessary worry. Many people believe that earning more money will cause all their income to be taxed at a higher rate, but that's not how tax brackets work. Only the portion of your income that exceeds a bracket's threshold is taxed at the higher rate. This misunderstanding can lead to unnecessary stress, so it's important to know how the system really works. To find your tax bracket, start by calculating your taxable income. Then, look up the current year's tax brackets for your filing status. Match your taxable income to the appropriate range to see which bracket you fall into. This process is straightforward once you know what to look for, and it's the foundation for accurate tax planning. Tax brackets can change due to inflation adjustments or new tax laws. Governments often update the brackets to keep up with the cost of living, ensuring that people aren't pushed into higher brackets just because of inflation. Staying aware of these changes helps you plan better and avoid surprises when it's time to file your taxes. In addition to federal tax brackets, many states have their own tax brackets and rates. Some states use a flat tax rate while others have progressive systems similar to the federal government. It's important to know which system your state uses, as this will affect your overall tax bill and planning strategy. Bracket creep happens when inflation pushes your income into a higher tax bracket, even if your real purchasing power hasn't increased. Some governments adjust brackets for inflation to prevent this, but not all do. Understanding bracket creep is important for long-term tax planning and for recognizing how inflation can affect your taxes over time. Your employer withholds taxes from your paycheck based on your estimated tax bracket. If your income or deductions change during the year, your withholding might not match your final tax bill. It's a good idea to review your withholding regularly to avoid owing money or getting a large refund at tax time. If you're self-employed, you're responsible for calculating and paying your own taxes. The same tax brackets apply, but you may also owe self-employment tax. It's important to set aside enough money throughout the year and understand how your income fits into the bracket system to avoid underpayment penalties. Not all income is taxed the same way. Capital gains, which come from selling investments, may be taxed at different rates than ordinary income. However, your total income, including capital gains, can affect which tax bracket you fall into for other types of income. Understanding how different types of income interact with tax brackets is key for smart financial planning. There are strategies you can use to manage your income and stay in a lower tax bracket. For example, contributing to retirement accounts or timing certain income can help reduce your taxable income. These strategies can help you minimize your tax bill and make the most of your earnings. Let's look at an example. Suppose you're a single filer with a taxable income of $50,000. The first portion of your income is taxed at the lowest rate, the next portion at a higher rate, and so on. Only the income above each bracket threshold is taxed at the higher rate. This example shows how your total tax is a blend of different rates, not just the highest one. Now consider a married couple filing jointly with a taxable income of $100,000. Their brackets are different from a single filer, with higher thresholds for each rate. This means more of their income is taxed at lower rates before reaching higher brackets. Understanding these differences is important for couples planning their finances together. The head of household filing status has its own set of tax brackets, usually with thresholds between those for single and married filers. This status is available to certain taxpayers who support dependents. Knowing which status you qualify for can help you take advantage of the most favorable brackets. Your tax bracket can affect whether you get a refund or owe money at tax time. If too much was withheld from your paycheck, you'll get a refund. If too little was withheld, you'll owe money. Understanding your bracket helps you adjust your withholding and avoid surprises when you file your return. Some government benefits like tax credits or deductions phase out at higher income levels. This means as your income increases and you move into higher brackets, you may lose eligibility for certain benefits. Knowing where these phase-outs occur can help you plan your income and maximize your benefits. Your tax bracket can influence your retirement planning. Contributions to retirement accounts can lower your taxable income and potentially keep you in a lower bracket. Withdrawals in retirement may be taxed differently, so understanding how brackets work can help you plan for both now and the future. Investment income, like dividends and capital gains, can affect your overall tax bracket. Some types of investment income are taxed at special rates, but they still count toward your total income. Understanding how your investments interact with tax brackets can help you make smarter investment choices. If you receive Social Security benefits, your other income can affect how much of those benefits are taxable. Higher income can push more of your benefits into taxable territory. Understanding your tax bracket helps you estimate how much of your Social Security will be taxed and plan accordingly. Education tax credits like the American Opportunity Credit or Lifetime Learning Credit phase out at higher income levels. Your tax bracket can determine whether you qualify for these credits. Knowing where the phase-outs occur helps you plan your income and maximize your education benefits. Healthcare subsidies, such as those for health insurance through the marketplace, are based on your income and tax bracket. As your income increases, you may lose eligibility for subsidies or see them reduced. Understanding your bracket helps you estimate your healthcare costs and plan accordingly. The child tax credit also phases out at higher income levels. Your tax bracket can affect how much of the credit you receive. Planning your income to stay within the phase-out range can help you maximize this valuable credit for your family. The deduction for student loan interest is also subject to income limits. As your income increases and you move into higher brackets, you may lose eligibility for this deduction. Understanding where these limits are can help you plan your payments and maximize your deductions. Contributions to traditional IRAs can reduce your taxable income, but there are income limits for deducting those contributions. As your income rises and you enter higher brackets, you may lose the ability to deduct IRA contributions. Knowing these limits helps you plan your retirement savings effectively. Roth IRA contributions are also subject to income limits. As your income increases, you may be phased out of eligibility to contribute to a Roth IRA. Understanding your tax bracket and total income can help you plan your retirement contributions and avoid surprises. High earners may be subject to an additional Medicare surtax on wages and investment income. This surtax applies once your income exceeds certain thresholds, which are tied to tax brackets. Knowing where these thresholds are can help you plan for the extra tax and manage your income accordingly. The net investment income tax is another additional tax for high earners, applying to investment income above certain thresholds. These thresholds are based on your filing status and tax bracket. Understanding this tax helps you plan your investments and avoid unexpected tax bills. The alternative minimum tax (AMT) is a separate tax system with its own brackets and rules. If your income is high enough, you may have to calculate your taxes under both systems and pay the higher amount. Knowing about the AMT and how it interacts with regular tax brackets is important for high earners. If you own a business, your business income can affect your personal tax bracket. Some business income passes through to your personal return, potentially pushing you into a higher bracket. Understanding how your business income interacts with tax brackets is essential for effective tax planning. Charitable donations can reduce your taxable income and potentially keep you in a lower tax bracket. Itemizing your deductions to include charitable giving can be a smart way to manage your tax liability while supporting causes you care about. Alimony payments can affect your taxable income and therefore your tax bracket. Depending on when your divorce agreement was finalized, alimony may be deductible for the payer and taxable for the recipient. Understanding how alimony affects your income is important for tax planning after a divorce. Unemployment benefits are considered taxable income and can push you into a higher tax bracket if you receive them for an extended period. It's important to plan for the tax impact of these benefits and set aside money to cover any taxes owed. Income from gig work like driving for a rideshare service or freelancing is taxable and can affect your tax bracket. It's important to track all your income and understand how it fits into the bracket system to avoid surprises at tax time. If you have more than one job, your combined income determines your tax bracket. Each employer withholds taxes based on your income from that job alone, which can lead to underwithholding. Understanding your total income and bracket helps you adjust your withholding and avoid a tax bill at the end of the year. Sum up: understanding tax brackets is essential before you begin any tax planning. Know your filing status, calculate your taxable income, and check the current year's brackets. Remember, only the portion of your income above each threshold is taxed at higher rates. Deductions, credits, and different types of income all play a role in which bracket you fall into. Staying informed and planning ahead can help you minimize your tax bill and avoid surprises when it's time to file.